Welcome to You and Your Money. I'm Jim Zahansky, Principal Managing Partner at Weiss, Hale & Zahansky Strategic Wealth Advisors. Let's dive into today's topic.
Let's go through your market update. What's going on?
I mean, it's almost halfway through the year. It's hard to believe, right? I mean, we're approaching the end of June, so much of today's segment is going to be focused on what do listeners and investors do mid-year. And honestly, you know, if you go back to where we started the year in January and we were on this show, what do we say about what would happen in markets? And there's always prognostications. I think we didn't expect it to be this strong.
We were so jacked up for interest rate cuts. We just knew interest rate cuts are coming. This is maybe 3 this year.
And we're still hoping.
Right.
Well, we might get 1. But interestingly, you know, what's happened along that route is that markets have performed. Why? Well, largely because the Federal Reserve, based on this interest rate dialogue you're bringing up, has sort of engineered what we're calling a soft landing. That is, they're bringing down inflation without putting us into a recession. And interest rates have remained, no question, high. And so as we look forward, and I think these are the themes as we look forward at mid-year that we're focusing on, you know, we see the S&P 500 up double digits. The NASDAQ is leading the way. That index is leading the way, almost up 20% year to date. And the Dow Jones is lagging a little bit behind that with single-digit growth. And, of course, the U.S. bond aggregate not performing as strong as the stock market, which we'll talk about the impact of that in your portfolios, nor is money markets. Now, I mean, everyone's sort of running to this 5% money market thing. When I compare that to what the S&P's done over the last 2 years, there's about a 30% delta. So, All right. You know, you got to. It's nice to get guaranteed money, but you did leave some money on the table if you're doing just CDs and money markets. So as we look forward, we're going to, today dig into what are the risks in the market and how do you apply them to your portfolio and your savings as we sit here mid-year.
All right, fair enough. So mid-year outlook, that's what we're doing today. So the market's obviously taken off, as you mentioned. Past performance doesn't guarantee future returns. What factors are driving this incredible bull run right now?
We sort of talked on it. I mean, you said it. I mean, it has been all about interest rates over the last few years, particularly across the world. And the U.S. is really nicely and disparately led the way in growth, both in the markets and obviously through monetary policy. So, obviously the Fed engineering some sort of soft landing is helping, meaning we've not gone into recession. Jobs have remained, unemployment's remarkably low. Wage growth has increased. So generally, when you look across the U.S., it's a strong economic performance, which has driven markets up and improved corporate earnings.
Let's talk about risks. What do you see on the horizon?
Yeah, I mean, the risks that we're speaking of in our investment committee are not dissimilar. I mean, if you link it back to interest rates, it's, will Fed policy stay on point? Mm-hmm. Will they manage interest rates so that jobs can continue to grow, that people can continue to earn more money? So that's one. There's also geopolitical risks out there. We have the Russia-Ukraine conflict still going. We have some alliances with China that we're watching closely. That's certainly always a risk on the geopolitical front.
Putin and North Korea, they're like best friends now.
Yeah, I mean, so these are the geopolitical risks that you're always watching, and what those impacts could be. The other risks, of course, are the ones we don't know about, these exogenous risks. And if you look at the markets that what has impacted the market the most in the past 40 years, it's these exogenous events like 9/11, the pandemic, the collapse of the financial system in 2008. So those are the ones we don't know about. The ones that we are thinking about certainly are in our way. And then obviously we have an election coming up, so we'll have to watch policy changes. But nonetheless, we're fairly, when you look at where we are mid-year, the risks are fairly low. We obviously watching these and I think the ones that could drive the most are interest rate or policy changes that that would impact interest rates and cause the stock markets to not go as strongly as they have in the first half of the year.
All right, drill down a little bit too on some of the sectors and asset classes that are really doing pretty well right now. Tell us more.
Yeah, well, I started off the segment talking a bit about the indices. So, like if you think of the NASDAQ, that is mostly a tech index. And so that one is up 20%. So what's driving it? Well, there's these themes like artificial intelligence and essentially growth stocks. So whether it's NASDAQ or the S&P 500, growth stocks are really driving, these large company growth stocks are driving the indices stronger, largely because they're able to have the capital to invest, see growth, and take advantage of these trends in artificial intelligence. And that is really driving markets up because those earnings, they're achieving unprecedented earnings, which is how their valuations go up and how their performance for their actual stock is improving.
How about, should we, again, mid-year look, we're taking a look at our situation here, rebalancing, any readjusting here?
Yeah, I mean, it's something we would always recommend to our clients because over the last few years, you've had this disparity I was just talking about when I mentioned, the three stock indices really up strongly, yet the bond index not. And so when that happens, if I'll give this the classic 60-40 portfolio, 60% equities, 40% bonds, you're probably overweight equities right now, overweight stocks, because you essentially those have grown faster than your bonds. So you're probably taking more risk than maybe what your profile, if you're in a 60-40, would be. And so therefore you have to go in and look at your 401k, maybe do an auto rebalance through your provider. But I think the most important thing, Gary, when you consider it mid-year, is your risk tied to your goals? What are you trying to accomplish both in the short term and the long term? And when you think of those, are you in the risk profile to achieve the goals?
Okay, sounds good. All right, so again, final takeaways for listeners today. Last word, what do you got?
It's mid-year. The markets have performed generally pretty good. However, there is disparity in them. So look at and talk to your advisor about how you're allocated and make sure you're in the parts of the market that have done quite well. And when you do that, and where they're going forward. When you do that, adjust it to your goal and make sure your financial plan stays on track. And that is a nice thing to do mid-year. It's kind of like, it's halftime of the Celtics, championship, and you have to look at what's working and what's not. And if you don't, you're just you might be leaving money on the table.
All right. Always good advice, Jim. Always great to see you. Thank you for coming by today.
Yeah, nice to see you.
For more information regarding wealth management and customized financial planning with Weiss Hale and Zahansky Strategic Wealth Advisors, please visit whzwealth.com. Weiss Hale and Zahansky Strategic Wealth Advisors offers securities and advisory services through Commonwealth Financial Network, member FINRA, SIPC, a registered investment advisor. Fixed insurance products and services offered through CES Insurance Agency. They practice at 697 Pomfret Street, Pomfret Center, Connecticut 06259 and 392A Merrill Road, Tallinn, Connecticut 06084. They can be reached at 860-928-2341. Weiss, Hale, and Zahansky Strategic Wealth Advisors do not provide legal or tax advice. The tenured financial services team strives to support clients in achieving their financial life goals while providing absolute confidence and unwavering partnership for life.